All right, everybody. Hey, welcome to our Note Nation Top 40 Tour as it rolls into the Golden Triangle of Raleigh-Durham market out there. Glad to have you all here join us as we are 60% of the way done through our top 40 cities. This marks market number 25, and couldn't think of a better city that I enjoy visiting, enjoy investing in. North Carolina not only is a great state to invest in, but I'm a big fan of the Raleigh-Durham market out there as well. So welcome. If this is your first time joining us here on the Note Nation Top 40 Tour, we are glad to have you. We've got a variety of local and national investors, people investing or living in the Raleigh-Durham area, North Carolina area. I mean, it's a very popular state with investors across the country. You can always check out the replays to the previous cities along with the future schedule by going to notenationtop40.com. As always, we do record these. So if you want to catch these, you can catch the replays there. You can always go to weclosenotes.tv as well, which is our main YouTube channel too. I will be discussing the statistics and the different numbers going on in the markets there. We'll talk about future opportunities. We'll also talk about where to look for those deals and how to get started. So those that don't know me, my name is Scott Carson, everybody. Ladies and gentlemen, I have been an active real estate investor since 2002. Love what I do. It's been a great ride over the last 18 years since I bought my first house. I am the CEO of weclosenotes.com. That's where you can find a list of our different trainings, our podcast, and a variety of great other educational opportunities for you guys. But over the last 10 years, I've purchased over $500 million in debt, closed on thousands of real estate transactions and deals all across the country. Now, I've been teaching real estate investors since 2004 how to tap into distressed assets, how to buy deals, how to market, and I really have a passion for it. I'm the host of the No Close Show podcast, which is a nationally syndicated podcast show with millions of listeners each month, and I invest all across the country. For those that don't know, Austin, Texas is home. And absolutely love it here because I'm roughly about two and a half hours from 90% of the country. So, but why am I doing this? Why am I taking time on a Wednesday evening to spend time with you? Because I've got a mission to help investors to accomplish their goals and dreams and increase their wealth through debt investing or working in default and distressed assets. And there's plenty of them out there. And we're literally can see the tidal wave of distressed assets just coming down the road here in the next few months. So why am I doing this, guys? Like I said before, I love to help people. I love to solve problems and help people that are facing issues out there. I do believe that what's going on right now is one of the biggest opportunities that you'll ever see with everything that happened over a decade ago with the Great Recession. That was an amazing opportunity. If you weren't in real estate or weren't investing at that point, hey, guess what? You probably kicked yourself, man, I wish I could have gotten in on some of that stuff. Well, history has repeated itself twice in roughly 20 years here, everybody. So now's the opportunity to dive into this. And I'm also very passionate about doing this because I was once a distressed borrower back in 2000, 2003. Bought a house, thought I'd be an investor, and literally lost my shirt and was facing bankruptcy and was able to pull my assets out of a sling. So I've had a lot of empathy for those that are facing difficult times right now. And I'm a big believer that you can make money by helping people out of bad situations, especially with what they're facing right now. So there is nothing greater than a feeling, guys, than helping someone overcome an obstacle or achieve a goal or dream that they thought was once impossible. I don't care what your dreams or goals are. You have to think about, I do care that you have them. I don't care what they are, because if you're willing to put the work in and willing to be coachable, there are a lot of opportunities just about everywhere. Okay. And I have a big goal of helping over 1,000 investors over the next 12 months capitalize on what's going on in the markets right now for a long term. So where are the opportunities, ladies and gentlemen? This is a question I get asked every day, and the answer is they are everywhere. I don't care if you're in the self-storage business, the apartments, the single-family homes, the mobile home parks, office space, commercial spots, hotels, motels. There are deals everywhere, and I've been looking at some stuff on some of the different websites and different things that we track, and I've just been kind of blown away at the amount of stuff that's popping up on a regular basis out there. And the beautiful thing, ladies and gentlemen, is that with what's going on right now and the banks that have a lot of the stuff on their books, the other opportunities, they don't care how old you are, whether you're young, they don't care what color skin you have. They don't care if you've been a successful investor or a business owner, or you failed or you're struggling. It doesn't matter. If you're willing to put a little bit of work in, I know work for many people is a 4-letter word, willing to put the work in, this is the opportunity of a lifetime. I don't care what kind of experience or background you have. If you've had your own country western song, I get it. The beautiful thing, ladies and gentlemen, is that you could come out of this, what's going on right now, over the next 12, 24, 36 months, smiling because you've made life-changing decisions, not only for yourself, but also for your family and friends when it comes to building and growing wealth out there. And like I said, whatever your goal is, that's great. First, most important thing I can tell people, to get anywhere, you've got to have a goal. And that goal could be sitting on the beach drinking pina coladas. It could be sitting there retiring your spouse from a job that he or she hates to spend more time with them. It could be putting your kids through school. It could be literally retiring your parents. Maybe they haven't planned well. They've been hit. Maybe it's traveling more with your friends and family, seeing some exotic places. Maybe it's just upgrading your house or saving your house if it's a struggle thing. Maybe it's new toys you want to do. But the one thing I do know, that dreams and goals, while it's great to write them down, they take a little something to accomplish, and they take capital. They take money to make things happen. And with what's going on in the market right now, there's never been a better time to dive into what we'll be talking about later here, to build your own wealth, to create your own capital, to create your own cash flow, to really get things rocking and rolling here over the next 12 to 24 months, everybody. So what do the national numbers say? These numbers are through as of last month. We don't have the exact updated numbers yet, but currently, based through June, we were seeing an 11.1% unemployment rate. Basically, 1 out of every 9 employees, potential people, were unemployed. Over 40 million people collecting unemployment. 52% of small businesses are expected to fail once we get through this whole pandemic thing. That number is increasing every week. Businesses are shut down, or cities are shut down, or state homeowners. It's just a bad thing. Now, the thing is that before all this happened, 1 out of 10 homeowners was already struggling to stay current. We already saw, seriously, 10% of them mortgages were at least 30 days behind or more. All right, not quite 90 days, but that number has grown now, where we see 1 in 12 borrowers are in delinquent status. They're at least 90 days behind their mortgage. That's what delinquency means. Not just behind, that's 10%. But literally 1 out of 12 is at least 90 days, and that number is going to get worse when the new numbers come out. Currently, there are 4.1 million Americans currently in default. Yeah, 4.1 million borrowers currently in default out there. Now, to give you a bit of an idea on that, if you look back to what happened in history, just in 2008, 12 years ago, it took us roughly 18 months to go from 0 to 1.6 million defaults. Well, we're 2.5 times that number in less than 6 months. Do we think it's going to be bad? Yeah, I think we're going to see something, at least 10 million borrowers in default, and we're going to see it maybe get even beyond that. And it's not just bad borrowers or people been laying off. There's all sorts of loans that are defaulting. You've got non-prime, you've got, that's the new subprime if you don't know, performing, reperforming jumbo loans. Every loan category has seen defaults take place out there, and lenders are literally bracing right now for 15 million mortgage defaults. That's what they're expecting to see, up to that, maybe more. Now, if you look back at 2010, that's what the numbers capped out. We had over 15 million homeowners that were underwater in default. Do I think it's going to get that bad? I think it's going to get bad, but it's hard to say, because with the government kicking the can down the road, which I think is a good thing, giving borrowers the opportunity to do forbearance agreements for 6 months, or government ones to do it maybe even up to 12 months. But at some point, the piper's got to get paid, ladies and gentlemen. So who knows what's going to happen here. Now, if you look at the Housing Hardship Index for North Carolina, this is a report that Black Knight does in looking at the unemployment, the default rates, and kind of ranking the states on a state-by-state basis. Now, North Carolina is not the worst. It's not the best yet. But as far as it ranks as housing hardship, with the unemployment across the state averaging at 7.6%, that's better than the national average. That's, 30% better. You look at the default rate, the delinquency rate, 7.14%. It's a little bit better, 0.5 percentage point better, which is good. That puts North Carolina ranked number 34 nationally. Not bad. Like I said, it's going to be in the lower categories there. That's a beautiful thing. That's really a good thing there for everybody. There are others out there that are more dramatic. If you look at the map, the dark blue ones are the states that are really struggling the most. Now, if you look at the unemployment rates out there across the state, now, North Carolina, like I said, 7.6 is what the number said for June. And then I compared them and pulled up what Raleigh and Durham both showed in that. So Raleigh came in at 7.2 across the board. Durham and Chapel Hill came in at 7.0. So Durham actually has a lower unemployment rate compared to Raleigh, and then also compared to the rest of the state, which is not bad. They're both below the state average, okay? Now, looking at the county by county basis, this is Durham stuff. So I'm sorry, this is Raleigh. So Raleigh is at 7.2, Franklin's at 7.3, Johnston County 6.9, Wake County 7.2. You pull up the Durham area there. Durham's at 7. Chatham County is at 5.9. Durham County 7.6. Orange County in North Carolina is at 6, and then Person County is at 7.7. And you can see how that kind of compares on a county by county basis. Okay. Now, if you're going to look at the foreclosure markets, because that's obviously what happens a lot. People can't pay their mortgage. They're not working. They're going to keep food on the table, or they're going to pay the mortgage. And I guarantee the mortgage is going to fall out of that completely. So looking at the foreclosure rates, let's put them side by side up here for Raleigh and Durham. Okay. Raleigh has a foreclosed home, basically one in every, just over 9,000. Durham's a little bit better, one in every 8,100. Okay. A little bit better. And then you see the top 5 zip codes, 27610 for in Raleigh as one in every 3780. And then the worst zip code in the Durham market is 27713, which is one in every 4,700. So it's a better on the Durham side than it is on the Raleigh. I don't think it's really a surprise. If you look at this though, the Raleigh side, you really have the haves versus the have-nots. Okay. You know, you've got 2 zip codes that are really bad, then it really jumps up to there. Whereas in Durham, you've got more of the mid, the high to the low. People all over the place, they depend on this. So there gives you some opportunities to look at if you're tracking foreclosure in specific zip codes. That's where I would be looking at. Now, looking at the number of foreclosures, the number of pre-foreclosures or the auctions and bank guns, you can see you have higher pre-foreclosure percentage month over month and year end in the Durham market. Raleigh's down across the board a little bit there for you. And you can look at the charts here tracking that stuff. Now, obviously it's up, as they say, 900% over last month, because all you could have, if you had 9 foreclosures versus 0 or 1, that's 900% increase. You know what I'm saying? You've seen a spike in June as foreclosures have started to trend back up a little bit, as North Carolina's opened up or removed the eviction and foreclosure moratoriums. Same thing here. You saw a big drop off. I was actually kind of surprised about these numbers, especially the foreclosures in late February and March. March actually saw quite a few there compared to the rest of the country where it kind of dropped off. You can see that same thing. It was a little bit less in Durham there for you, but those numbers have popped up here in June as banks or the court systems have started to proceed with the foreclosures. Now, Black Knight mortgage, you know, it's talked about how we saw a 50% increase in May and April across the board. That's not really a surprise as people have been laid off. National default rate 7.76. We see basically currently 4.1 million borrowers in default, with another 4 million behind them that aren't quite in default yet. It's going to be a bloodbath out there. It just depends on when. It's going to be dragged out for a little bit. Now, looking at the statewide or nationwide map here, you can kind of see the different states that have taken different actions. The dark green is where there was current or were originally current statewide moratoriums. The light green was current local moratoriums. A very faded green, I guess you say, states where evictions have resumed. There's North Carolina. And then the tan, like here in Texas, no state or local moratoriums issued. It varied on a county by county basis. Now, the moratorium that was put in place there locally ended June 21st, okay? So you've had foreclosures kick in quite a bit over the last month as things have started to get back to normal. Same thing with evictions and foreclosures, therefore. They were talking about trying to extend it. Didn't happen. Now, what did happen, though, is President Trump did sign an executive order just a few days ago, taking people that had a government loan or were renting from somebody with a government loan, government-insured loan, to extend the foreclosure and eviction delay. And counties and judge are kind of taking their time. They're not being really aggressive on that. But this extended another delay through at least August 31st if you've got a government-backed loan or renting for somebody with a government-backed loan. Okay, so you've got a little bit of time frame. And do I think it's going to be extended some more? Yeah, I think there's going to be parts of the country that extend it. Now, if you look back at what happened in July, here at North Carolina is roughly about 7% of capacity. I'm waiting for a new number on this to come out because, you know, obviously the numbers are spiked a little bit more. But in July, it was roughly at 7% of what they were doing as far as foreclosures beforehand. All this happened. Now, what does this mean? Do we see a tsunami? Are we going to see the dominoes fall with job losses, mortgage payments, making it very impossible or difficult for people to make their mortgage payments and stay in time? Yeah, you're going to see some stuff. but it's all going to fall into specific categories. Now, looking at both Raleigh and Durham on Realty Track, the biggest percentage, overwhelmingly large percentage, is the homes that are at $200,000 or less are the biggest numbers of foreclosures that are taking place. All right, those are the biggest number of defaults as well. Now, what type of loan does that fall into a lot of times? Well, we've seen a huge spike in the amount of defaults in FHA loans, okay? FHAs sit around 9.69% of all FHA loans are defaulting, okay? And compared to all conventional loans, it's 3.16 across the board. You see VA loans at 4.65 and all the other loans are at 4.36. So it's a weighted average to get to that point. Now, what's the deal with the FHA loans? Well, those are borrowers that are usually getting in not based on credit, 3.5% down. And the banks, like Bank of America, are donating actually that down payment across the board to be aggressive. They figure they can make up that 3.5% in interest across the board. And then they're also paying down payment. BMA through February would pay the down payment and up to $10,000 in closing costs for an FHA loan because they realize they could get it, they could outbid everybody else and make more money on it. Well, that's kind of bit them in the butt in a little bit. We'll get to that in a second here. But we've all seen, yes, if it's a government loan, you can file a forbearance agreement. Fannie, Freddie, Ginnie, they've all said they're giving people initially 6 months. If you look at that time frame here in September, where that first 6 months is going to expire, they've already agreed. There's already been talk about it. I've been on the webinars, been on the conference calls with them to see that they're willing to extend another 6 months to give people an opportunity. And then even after that, they're willing to work out something for the variety. If you've got to go now, what does that mean? Well, if you've got a government-backed loan, good for you. If you don't, you're kind of up the creek without a paddle in some cases. That's not saying they won't allow you a forbearance agreement, because the biggest chunk of those is obviously Fannie, Freddie, FHAs there. Others are lower amounts, but they're still roughly 4.6, 4.7 million Americans of forbearance agreements, and that number will ebb and flow as people go back to work. But Black Knight, BlackRock, they all say there's probably another 4 million borrowers out there that should be on a forbearance agreement that have not called the bank. They're scared to call, and they're just pleading ignorance, which we see that. And you'll also run into a lot of loans that are below marks where there's what's not included in this is your owner finance, your contract for deeds, your investment loans like the second home, or if you are an investor taking on other loans out there as well. Those aren't covered a lot of times in that stuff. So those are going to be some things to be issued. Now, is this good news or bad news for us as investors? It depends on which way the wind blows for you, I guess you could say. But North Carolina does have a lower default rate versus the national average. I think that's a good news. It does usually have a shorter foreclosure time frame than a lot of the other states out there. That makes it very attractive. For a FHA foreclosure, based straight up from the FHA website, basically the non-judicial foreclosure would take roughly about 420 days to foreclose on from start to finish. You know, that's shorter than a lot of other states out there. If it's a non-FHA foreclosure, that foreclosure time frame is a lot faster, less than 6 months. Now, when you look at the backlog of forbearance agreements, you look at the backlog of people and the court systems not being able to process this in foreclosures in a steady fashion, you're going to see delays. If you're looking for REOs, foreclosed homes, and not just Raleigh-Durham, but all across North Carolina, it's going to be a while. 12, 18 months, you're probably not going to see a substantial amount coming from the banks until the middle of next year, if not later, the second half of next year, because the banks are kicking the can down the road for the most part. Not saying you won't see some, it just won't be as extreme as we think it's going to be. Now, what about commercial loans? Okay. We know that there's rent for rent signs all over the place. Buildings are getting boarded up. Businesses are shutting down. Commercial bankruptcies are all-time high. Businesses are going out of business. Big box stores, all sorts of the categories have been hit in a variety of fashion. They've been saying that the commercial boom was overdue for a turn. I've been saying that for about 24 months, that things were overpriced, and obviously the piper needs to get paid. So when you look at the asset classes in the commercial side of what's really in default through June, through Q2, the biggest one is obviously hotels, lodging. You look at any of the commercial websites, like I've been on auction.com and 10X today, and it's hotel after hotel, not small, but a lot of big Hilton, Hyatt, convention hotels in big cities and in smaller cities that are there. That's just a drop in the bucket. So lodging hotels are roughly at 27% default rate. Retail, which has kind of been on life support, is basically closer to 20% is what I've been told by bankers. Okay, you look at restaurants, office space has been hit pretty hard as well too for you. This office number down here is not accurate because you've seen a lot of people move home, and then a lot of the big companies like, hey, you're going to work from home all of next year. Expect that before we kind of get back into the thing. Now, looking at the top U.S. metropolitan areas by delinquent commercial debt, there's a big kind of a hit rate. When you look at what they're tracking, now Raleigh-Durham isn't in the top 15, but if you look at some of the numbers out here, like Cleveland's got 550 million, Chicago's 2 billion, Atlanta 690 million. You're seeing a lot of stuff out there. It's being hit hard. Now, looking at some of the things, what's going to be hit the hardest is the office space. Okay, they think it's going to be hit hard as we get through this. You also look at, obviously, there are quite a few properties flagged for concern in the Golden Triangle. They're expecting it to be roughly about $500 million in commercial loans. They're struggling there in the Triangle Raleigh-Durham area there. You know, you've got some different hotels. They're stealing, like $496 million alone on the hotel space. Another $300 to $400 million on other assets out there too as well. So let's look at that. 1 in 4 hotels across the country in default. That number gets worse as this drags on. I mean, I was out to Charlotte 2 weeks ago, and the hotel we stayed in, Nice Residence Inn, had been shut down for 2 months. You see that happening across the place. And the longer that these hotels are shut down, you've had some really iconic hotels in Raleigh-Durham get shut down and not plan on reopening. 1 in 5 retail loans are in default. They're expecting us to see an increase of at least 15% vacancy rate for retail and restaurant space going forward. Vacancy is set to increase to roughly about 20% nationwide. What does that tell you, everybody? Well, if you're looking at numbers, you're looking at buying an asset, you look at, okay, I'm going to collect 20% less rent than what they were doing a year ago or 6 months ago, which is okay, because if you're collecting less rent or your vacancies up a little bit, that it's going to drop the cap rates, the values down, and make things much more affordable, and also put the banks in a distressed status that they were willing to move some stuff off their books that you may not regularly see. We're expecting to see rents drop another 10 to 15% by year end, another 4 to 5 in next year. Leads to some opportunities. Now, it's not all the big guys on like Wall Street that finance a lot of this commercial stuff like it was a decade ago. Previously, beforehand, basically 2/3 of all the loans, it's just commercial loans, were financed by Wall Street or originated in the CMBS market. It's different this time around. The banks, your banks have gotten up and bellied up to the table and have been eating at the trough as well, where they've been financing a lot of stuff, actually financing 53% of the distressed loans that are out there right now. Now, they're not financing these at 100% or 95%. They're financing these at roughly 60 to 70 cents of value when they finance it. And commercial rents or commercial sales prices, values are calculated off of cash flow and your NOI. Figure out your net operating income and a cap rate normal in the market, and then you have your value. Well, if your rents are down, your vacancies increase, that's dropping the value down. So if a bank finance, let's just say 70 cents on the dollar, and you're down 20% in rents, your value just dropped 20%. You might need to bring 5 to 15% cash to the table if you're a current borrower to pay down your loan, to get it back to that 69% LTV. And you're going to have a lot of capital calls. There are already a lot of phone calls taking place. I've talked with quite a few bankers here, like, hey, what are you looking to buy? What are you looking to get off? I'm like, well, what are you looking to get rid of? What do you have that within here? Because we're getting a lot of stuff on here. I mean, it's sad out there, but you're going to see a lot of opportunities out there. Now, what do you do with this stuff? Well, take it over and then work with the borrowers of some sort. Bring some cash to the table, buy out some of these bad loans from the banks, and look to work with current borrowers to try to reposition the property out there. Now, if you're looking at reposition, we'll cover that in a second, but the banks are going to be stand to lose at least $48 billion or more on the commercial real estate side, just alone the commercial real estate side. And literally, commercial loans aren't judged the same as your residential loans. They don't have the Dodd-Frank that's hanging behind the commercial real estate side of things. When you look at what Bank of America announced just a few days ago, your North Carolina neighborhood Bank of America, right? They're kind of the bell cow of the banking industry when it comes to commercial. B of A has started to set aside billions of dollars in money to offset the distressed debt they have there. I mean, their shares slid dramatically, 98% a couple of days ago. Now, how much are they going to pony up the table? Well, it's just not them. But B of A is expected to see a $5.1 billion loss on the sour loans. Wells Fargo is expecting several billion. American Express, a few other big banks out there are also expecting us to see a big chunk of the table that they're going to miss out on, that they've overvalued, and they're looking to get off their books at some point. All right. Now that's a big, big chunk, not million, but billion out there for you. Now, if you're going to reposition stuff, what do you have to look to do? Well, you might need to reposition things like this guy did in Illinois. He took a hotel, repositioned it, and turned it into apartments, and really did an amazing job with it by, instead of having a hotel, turning it into something that's occupied there, because we do need to have affordable housing. There's a lot of need for apartment buildings. And if a hotel is built, it's basically set up a big chunk of the way already for residential. Now, our buddy Garrison Gilbert's out doing this in several places out there in Pennsylvania and Maryland where he lives. He's looking at several properties, a 55-unit hotel, turning into a 42-bedroom apartment, and then another old Days Inn of about 75 hotel rooms he's looking to turn into roughly about 62-bedroom baths. So that's the thing that you guys have to keep in mind here, everybody, is there's opportunity. You may just need to get creative in your pivot. Like this guy did in Denver. He took 110-unit office space, which we know office space, whoop, see you later. Very smart, and repositioned it and turned it into self-storage versus office space. Took it from an asset that's overvalued and way too saturated in that market and turned it into self-storage. There's 10 by 10 units. You might as well turn it into something versus nothing. And he's looking to get out of the property basically for what he's into it for. So that's a beauty. So where are the opportunities at when it comes down to finding deals these days? You know, do you want to be in the foreclosure and REO space? Well, you could, but it's going to take a while. It's going to take 12 months. And I guarantee you, the banks aren't going to be sending off a lot of the foreclosures because they'll have 6 months before really the end of the year to evaluate the portfolio, and they'll be looking to sell a lot of that debt off to other investors or other banks or institutions. Banks don't want to be in the foreclosure REO market, and they're not going to really don't want to take it that way either. Do you want to be in the fix and flip business? No. Hard money lenders are really tightening up their standards. Days on market are very, yes, there's properties moving, but I don't think you want to be in the fix and flip business just because you don't want to get stuck with having overvalued houses. I've been getting a lot of phone calls from hard money lenders, mezzanine financing, asking if I'm buying at par. I'm like, no. They're expecting to take a hit as days on market and end-term financing for fix and flips from banks have really slowed down. You want to be in the rental market? Heck no, I don't want to be in the rental market. When you look at people being evicted, you're looking at rents in different asset classes. I don't think you want to be in that aspect of things. So the real opportunities out there lie in buying that debt at a discount and debt gain, and then working out something with the existing tenants, existing borrowers, working to keep them in the game. Okay, now you're going to start seeing some residential notes, the mortgages on residential properties, not the REO side, but notes start to pop up in the fourth quarter. Why? Like I said before, the banks have had 6 months to evaluate their portfolio. They'll know who's on the naughty or nice list when it comes to who's paying or who's also delinquent on other things. On the nice list, they'll keep those. On the naughty list, they're probably going to look to move those off to somebody else. So it looks good that they got rid of it and let somebody else deal with that nightmare of the foreclosures in the new year. Now, on the commercial side, I've got buddies that are telling me they're seeing more deals in the last 3 months than they saw in the last 2 years. And I've seen number spikes across the board, and everybody who has a website or a portal for debt sales, DebtX, First Magnus, First Financial, 10X, Exchange.loans, all these guys have said in the last 48 hours, answer my emails, they're all said that they've seen a record number of listings come up, banks, institutions reaching out to them. And you can take a look at some of those websites and just see the increase in the number of things that are happening out there. So, but it's not going to be the big one. You're not going to be looking at the $5 million plus assets. Most of those are going to get gobbled up by the banks or the CMBS guys more so, because that's the way they play at. Wall Street, those guys, they don't want to deal with a lower valued asset, and lower valued for them is anything below $5 million. All right, the way they raise capital, the way they have access to feds and things like that, hey, that $5 million and beyond, you're not going to see much of that. But the biggest opportunity that has been clogging up the bank's bloodline is that smaller valued asset, $2.5 million or less in value, and being able buy one of those cheap enough from the bank and be flexible to tenants or borrowers. In some cases, the banks are even willing to carry financing for the note purchase, or if you're going to take the asset over, moving it from the non-performing side to the performing side of the asset sheet, the balance sheet. And that's where the opportunity lies. Anything that $2.5 million or less is where you can really dive into some really sweet deals if you're an investor who knows how to tackle the debt game. Okay. Now, are the banks in trouble out there? Yes, there are banks in trouble. We've already talked a little bit about this before. But one of the things that we track on a regular basis is the Bauer Financial List. Bauer Financial is a company that tracks banks on a quarterly basis, takes a look at what they file with the FDIC, and evaluates them to see, okay, are they good, are they bad, are they a 5-star or a 0-star? What are they in default? And one of the things that we do is we buy the list of banks that are 5 branches or more. So they've got a little bit of a footprint. The smaller, less than 5 bank branches, they're usually too conservative in their lending. They're not going to have a bigger default rate. They might have a couple assets, but I would rather play and fish in a bigger pond. So if you look at that list and break it down by states that are just based in North Carolina, where their main corporate office in North Carolina, there's thousands of banks that lend or do have offices, but as far as those based, there's roughly 20 banks based in North Carolina. Their home offices are based there. Obviously, one of the bigger ones in Bank of America. But you look at the numbers between those 20, there's a combined $9.4 billion with a B in loans in default, 90 plus days in default, and an additional, get this, $7.6 billion in 30 to 89 day lates. Okay, that means another quarter goes by and these people aren't paying. And probably at least 50% of those are going to roll into the default space. So you're talking over 10, 12, $15 billion in bad loans just really on those 20 banks out there. Now, that's an average across the board of those 20 banks of 3.75. Obviously, the lion's share of this, 75% of it roughly, falls on to 2 banks, okay? There are $6.4 billion in single-family residential 90-day defaults across the 20 banks. Bank of America has 6.3 of that 9.4 total. They've got $5.7 billion in single-family residential defaults out of that number. Yeah, okay. That's about $600 million in commercial loans they're looking to get rid of. You look at the BB&T Bank, which is the second biggest one, right? They have $2.7 billion in defaults, and an additional 607 out of that 2.7 is 617 million in single-family residential. So BB&T is roughly about $2 billion in commercial loans in default. All right, B of A, much more of a residential bank versus commercial. BB&T more commercial than residential. Bank of America over 5,000 branches. BB&T roughly 2,500, 2,700 branches across the country. Okay, that means there's opportunity, everybody. That's just for those 20 banks. Think about all the other banks lending in North Carolina. North Carolina is a very desirable state because they're the faster foreclosure state in the value. So why would you want to reach out and buy distressed debt? Why would I want to buy a mortgage on something that's non-performing? For a couple of things. One, you can start doing deals now, sitting around here at COVID, watching everything on Netflix and twiddling your thumbs for 12 to 24 months. You start doing some deals now and taking down these deals and get it repositioned before they ever hit the open market. I mean, we see note deals 6 to 12 months before your traditional foreclosure buyers too. You can buy that debt at significant discount, well below as is value, well below what's owed. And depending on where the location is, the foreclosure time frame, the values, the condition, et cetera, you can really do some really great damage in your case of modifying, turning it into a good ROI by working out something with the borrowers or the tenants. You can purchase that debt, control the asset for huge discounts, like I said, 30 to 70% off. And there's a lot of strategies: loan reinstatement, modification, short sales, short payoffs, foreclosures, loan sales, deed balloon, cash for keys. On the commercial side, it's great. You can take over receivership if they file bankruptcy. A lot of opportunities for you to do on the distress side of things. Now, take over the note and turn it into a cash flow performing note is the preferred thing. You buy it at 50 cents on the dollar, it gives you a lot of flexibility. Said, okay, Mr. and Mrs. Borrower or Mr. and Mrs. Tenant, I know you've been behind. Let's not worry about the last 6 months. Let's worry about you starting to pay now. Can you go back to work now? Can you start opening your thing and get started back now? Okay. Or you can just take over the property and do what you want. All right. Take over the property, have the borrower walk away, take the property back, turn your hotel into a apartment complex. Take your office, turn it into self-storage. Convert the Starbucks coffee house into something else. Whatever. There's a lot of things you can do, or keep it. That's the thing that I love about this, everybody. There's also some other advantages about note investing. I know that many real estate investors, they get into sending out direct mail. They struggle in marketing because they're like, oh, I got to send out another 5,000 postcards. I got to drop another couple grand on marketing. We don't do that in the debt space. We're not sending out postcards. No. If you've got email, if you can jump on LinkedIn or pick up the phone and dial for dollars, you can do this business. And everybody that that's on this, that's not deaf, okay? You can do this from the comfort of your own home or office, okay? One source leads to multiple deals on a regular deal flow. Not, oh, I'm gonna send out postcards to get 4% response and maybe find one deal and I gotta do the whole thing all over again next month. That's not how it works. I have banks that have been sending me lists every quarter for the last 6, 7, 8 years on stuff on a regular basis, okay? Never sent a postcard. Well, I did say a postcard to the ask Mr. Thank you, but not a postcard to find them. It all came from, like I said, emails, LinkedIn, and phone calls as well out there for you. You can cherry pick your best deals for your portfolio. You can buy in bulk and get better deal pricing if you need to. The banks aren't going to require you to bring $50 million to the table, okay? You're not going to buy a one-off residential note from Bank of America or Chase. They're going to want to spend something like $50 million into this stuff. That's okay. But there are plenty of other banks and lending institutions out there that have bad debt on the commercial side that you can cherry pick, or even the residential stuff that you can take a look at. Do the stuff from the comfort of your own home or office. And you know what, guys, you don't have to have your own capital. You have your own money. Bank doesn't care what your credit looks like. They don't care if you're in forbearance in your primary home. They're not going to be checking your credit. There are thousands and thousands and thousands of other investors out there to fund your deals that are waiting for you to give them a phone call. And guys, if you don't think there's opportunity, think about this. History repeats itself. 15 million homeowners in default 12 years ago or 10 years ago. We're going to get close to that. The biggest regret that I have from 10 years ago is that I didn't buy more. Okay? There are so many opportunities out there. So, yes, there are plenty of investors out there to help you out with, guys and gals. Plenty out there. There's over $9 trillion in retirement funds sitting out there basically on the sidelines, not really getting anything. A lot more IRA is going to be transferred here with job losses and people leaving companies and doing that as well. If you look at just what's going on in the Raleigh-Durham market for the most part, okay, there are 22,000 investors with an IRA in the Raleigh-Durham market, okay, 22,000. Out of 22,000, 15,000 of them have at least 150 grand or more in their account. I know that's crazy. You wouldn't think that, but yes, 2/3 of them have at least 150 grand or more. How many investors do you need to take down a property? I mean, I saw a mall. Malls are basically going to go the way of the dodo bird, I think. Half of them are going to be gone out of business. But there's all sorts of stuff already in the Tar Heel state that you pick up really cheap and well below value. Now, if you don't want to raise capital, there are at least 15,000 real estate investors, people that pay taxes and call themselves real estate investors in the area as well that you can flip the deal to. So go find the deal from the bank and flip it, make a wholesale fee or an assignment fee, or get your investors to fund the deal and be partnered on the deal. Get something, guys and gals, because do you want to be the borrower or the banker? All of you right now, if you're not in the note game, well, you all are the note game. You're on the borrower side. You're paying out. You don't want to do that. You want to be the bank. You want to get it in. Banks aren't doing fix and flips. They're not doing Airbnbs. They're not doing short-term rentals. They're not doing any of that stuff. The bank wants to own the paper, and the bank always wins, ladies and gentlemen out there. And there's so much being pumped into savings right now as people are saving for a rainy day. We've got a record number of cash savings amid the pandemic and uncertain economy. This just came out a few days ago. Look, guys and gals, there is so much money out there. People are looking for ways and opportunities to put their hard-earned money to work to pay them a decent rate of return, okay? And here's the thing, guys and gals, the bank always wins. The bank always wins. The pen is mightier than the sword. The pen is mightier than the hammer, okay? Yeah, the banks are hurt, but here's your time to swoop in and be able to pick up some assets and be able to really change the outlook on your long term. So how do you tap into the tsunami of deals? But guys, I've been teaching investors about notes for over a decade now. I've bought over $500 million in debt. I've helped thousands of investors purchase their first non-performing note by also purchasing thousands of non-performing notes for my own portfolio. I've done residential commercial notes. I've done apartments. I've done self-storage, mobile home parks, hotels, motels, beachfront condos. I've done a variety of different deal flow out there. And whether you're looking for cash flow or asset growth, you want to take some stuff down to add it to your real estate portfolio, now's the time to be acting. Now's the time to be making those connections with the banks. Now's the time to be reaching out and honing your craft to learn how to do this so that when everything is hitting the fan, that you're coming out way ahead of everybody else out there. And yes, you can buy in one-offs or in bulk. There are hundreds and hundreds and hundreds, if not thousands of banks out there that will sell you one-off assets all day long. And there are people out there, well, if the bank won't sell you an asset, won't sell you no bullshit, they sure as hell will. I'll prove it. Okay. And you can do trades from anywhere from $25,000 to $5 million. We've done a lot of them. Bought the single note for $7. Bought a big 300 unit apartment complex for $5 million. Guys, there's so much opportunity hitting here. And like I said before, you don't need your own credit. Don't need your own funds. Bank doesn't care. If you've got other people's money, great. That's all that they care about. They don't need to look at your credit. Don't know if you've been through your own ringer. If you have the ability to put the team together and make some things happen, guess what? You can do this by starting with just emails, LinkedIn, and a phone number, and knowing what to say, what not to say, and following our coaching and our lead to show you the best ways to do this. Now, like I said, whatever your focus is, single family, apartments, hotels, motels, retails, office, self-storage, it doesn't matter. There are deals in all sorts of asset classes out there. And you can really do some good by creating some win-win scenarios, win-win stories out there, not only for yourself, but for those borrowers, that salted the other people that are living in homes that are struggling, or the commercial side of things. Commercial developers have built great property, but they're over encumbered now because the market had dropped off. It's an opportunity. No matter what your focus is, whether it's big deals or a smaller deal, the banks are flooded with this stuff that they're going to be looking to get off their books very soon. And it's up to you if you want to take advantage of that. It's up to you if you want to be a part of that. Or you can sit here and keep waiting for your boat to come in. Well, the boat is it's in port, baby. It's time for you to take advantage of what's going on there. Jump on the boat, jump on the train, and get ready to ride this thing. So you can do it big, you can do it small. I don't care what your experiences or lack of experiences. We've worked with investors of all types, just like Gene here. Gene is out of Indiana. When we first met him a few years ago, he was doing a few fix and flips. He was buying an occasional note here and there. We spent some time, trained him up, got him rocking and rolling. Fast forward now a couple years later, closed on over 130 deals, raised over $14 million in private capital, and has made a whole different definition of retirement for him. He's no longer a hotshot driver. He's doing the things that he wants to do. He's given a whole new meaning to life for Mr. Gene here. We're very proud of him. It's also got a big meaning difference for Laura. Laura's out now from Maryland, originally from South Austin, Texas, a place called Wimberley, basically, and has done an amazing job. When we met her, she was like many real estate investors, going to real estate investment clubs and meetings and workshops, trying to figure out the best way to do deals. Wholesaling here, light rehabs, like many investors running around like chicken with their head cut off. We taught her the note business. Fast forward the first 18 months, she closed on 14 or 15 deals. After that, a couple years now, she's closed on over 100 deals and done an amazing job getting ready to close on a big portfolio of 100 plus assets for $4 million with other people's money. Life-changing deal flow for her, and she's done an amazing job, and we're very proud of what she has done and accomplished. We've got Keith Collins here. Keith has done a lot of different deals, a lot of residential stuff, some commercial stuff. I think opened and created water treatment plants. I think he was also the mayor of a small town in Ohio. He emailed me just the other day and said, Scott, I love the note business, love what you taught me. We're going to make 7 figures because of what you've done and what you've taught us and how we do it. And he said, I'm never going to retire. I love what I do. This is a great thing. I'm looking at my shots about 2020, and we're excited for what he's doing. And all these guys and gals, great. Like I said before, don't care what age you are. Don't care what color your skin is. Don't care how much experience or non-experience that you might have. And yeah, these guys all and gals have some experience. We could be like our buddy Raphael from San Diego has done an amazing job. When he first came to us, no experience, learning more about real estate, doesn't even own a house. And we've trained him. We've done a really good job with him. He bought 5 notes within his first 30 days as a student of ours. 2, he got reperforming, bringing in about 20% cash and cash return. Yes, pretty good return for his own funds because he was a business owner. The other 3, he's in the process of selling 2 and then probably keeping 1 in the workout. But in San Diego, as a business owner, he owned a car detailing business. And if you're not driving anywhere, you don't want somebody to come over to clean your car if you're not driving and stuck at home. So he had to shut down. He had to lay off all 15 of his full-time employees And he's just like, ugh, this is not what I want to do, but I'm going to come out smelling okay because I've learned the note business. I've learned how to invest in real estate in markets outside of San Diego, and he's doing a great job. Like I said, I don't care if you're brand new, don't have a lot of experience. The way we teach people how to tap into the note markets, that's what we call our classes in the note buying for dummies for the most part, is that we're taking people and really helping make America great again, one defaulted borrower at a time. Now, like I said, we've done this for hundreds and hundreds and hundreds, if not thousands of investors all across this great country of ours, and tapping into to close deals, to change their lives, to change their outlook, and help them get closer to their goals and dreams that they've set for themselves. For someone's leaving the job, for someone's retiring their spouse, for some of them it's just to have more income to survive on. And we're very proud of the fact that we do such a great job. I was the Educator of the Year a few years back. I was runner-up, I think, last 12 months ago. And then how do we teach people? Well, the best and the very first step is our Note Weekend training. Our Note Weekend class is a one-day online course that you spend with yours truly via the Zoom, like this, the Zoom. And it's a mini workshop. You're not going to learn everything about the note business in one day, let alone like a 3-day workshop, but it is a very intense one-day class where our students call it the Cliff Notes version of note investing. We'll spend time with you all day Saturday, roughly from 9 a.m. to 3, 4, 5, 6 o'clock at night. As long as there's questions being asked, I'll go through it. The replays are included, so if you've got to miss a chunk on Saturday, guess what? You can watch the replays starting on Sunday. Normal price is $97. We've dropped it to more than half, to $49. Like I said, at least 9 to 3. If you go to noteweekend.com, you can literally see the full schedule and the outline of what we cover basically on every half-hour basis. Pretty close to it. Sometimes we run a little fast. Sometimes we run a little slow. That's okay. It's a guide to help you out there. Now, we host this class one weekend a month, one Saturday a month, usually the third or fourth Saturday. Depends how the weekends fall, but we've got a couple that are upcoming here. We usually host this 8 to 9 times a year is what we got planned to host it here in 2020 for you guys. If for some reason you can't make it, you can always get bumped to the next month's class out there, and as we're constantly updating it. No, I don't record it once and that's all that we show it up there. I'm constantly updating the training on a month in, month out basis because the market's constantly changing. Now, what do we cover? Well, the first part we're going to cover is how and where to find the notes. You walk out of our Note Weekend class with a database of over 2,000 asset managers and bankers to be able to tap into those via phone call, via email, or reaching out to them online. We'll talk about how to fund these deals with OPM. Yes, OPM is other people's money. We'll show you how to tap into investors in your local market, your local zip code, who have either lent money out of their IRA or who have bought property with their self-directed IRA that you can tap into. We'll also talk about the different exit strategies. You know, we'll talk about finding the funding and now the flipping the notes, whether it's wholesaling it or flipping it through the legal process or working with the borrower to keep them in the property with a modification, a reinstatement, and holding on to it, and then selling the asset off later on. There are a lot of different ways to make money in this business, and we'll show you how to do that. We'll also talk about the different vendors and teams, members that you need to put in place if you're buying across the country. Hey, you're going to need to have some realtors. You're going to need to have a servicing company. You're going to need to have some attorneys to be in the foreclosure process. We'll go through all of that stuff there for you and show you where we get our Rolodex from. We'll also talk about some of the different loan trading platforms I hinted to, some of the different major websites so you can start looking at deals today, residential and commercial deals, and making offers and getting your systems in place to really ramp up, be ready to rock and roll by the new year. We'll also talk a variety of things, marketing, some legal protection stuff, a little bit of stuff there, but it is a very intense, packed, basically 9 a.m. to 4 or 5 o'clock in the afternoon for you guys out there. And like I said, love for you guys to be a part of it. All of it just for $49 at noteweekend.com. You can get signed up tonight, and we can literally send you some stuff to get rocking and rolling for you tomorrow morning. Now, if that's not enough, let me throw in some other bonuses to make it even more worthwhile for all of you. Now, we're going to throw in over $1,000 in bonuses for you. Not only are we going to drop the class from 97 down to 49 for you, that's a big thing. We're going to also throw in our one-day calling banks training. This one usually happens the Wednesday after the class, where you can be a fly on the wall and peek over my shoulder as I dial for dollars to bankers for 4 to 5 hours. You can hear the conversations. You can see who I'm talking to. You can ask questions. You can see my correspondence back and forth. People love this. We usually charge $49 by itself. We'll throw in there as well too, and the recording to the previous one. Yeah, I know, right? Craziness. People send me, it's their favorite thing to watch me call because it takes away a lot of their fears. They'll see me goof up. They'll see the conversations. It's not unknown but you'll actually see me making connections. Last time I did it, I had resources, 4 or 5 banks that were ready to send me some deals that we're working through. We'll talk about throw in the Bauer Financial list, the most recent quarterly report for you. That's a $400 plus value for you guys. You'll be able to see the banks that are struggling, what they have on the residential side in default, what they have on the commercial side in default, multifamily, other things on their books that they're looking to get rid of. Not the actual assets, you'll have to reach out to them, but you can see who's got what that you might fall into what you're looking for. I charge $1,000 for consulting, $1,000 per hour for consulting. And I always like to schedule a 30-minute phone call with our students after the class to get a feel where they're going, to help point them in the right direction. And everybody gets all ramped up. The last thing you want to do is go start doing something that doesn't make sense. And so we like to kind of steer you in the right direction. That's a $500 value. I'll throw in as well, if you've got a spouse that wants to join your business partner. As I mentioned, the replays are included as well there. Also, guys, we've got a great Facebook group of over 900 investors that I'd love to have you be a part of too. Great resource for bouncing ideas, asking questions, finding realtors, finding buyers for deals when you get tapes in, and vice versa as well out there. That's included there for you. But altogether, over $1,000, $1,200, $1,300, $1,400, something like that. I don't know what the final number is. But guys, we want you to be a part of this. We want to take away a lot of the reason. I'm literally going to give you the sources. I'm going to also throw in a 20-page manual for you to walk through that kind of step by step, so you can always go back to it. Great refresher, great starting point. Dip your toe in the water and see if this is for you. But all this for just $49, ladies and gentlemen. It's not meant to be difficult. You get the class, you get the replays, you get my 4-hour training on calling banks, you get to talk with me on the phone, you get the Bauer list of financials, you get a group of 900 investors to reach out to. What the hell else do you need? I'm going to show you how to find the funding as well for you guys as well out there too for you. So once again, guys, all of this for just $49. If you go to noteweekend.com, you can get signed up tonight. Get signed up tonight. We'll send you an email tomorrow with links to the replay. So the last class you can start watching and get rocking and rolling. Like I said, whatever your goal is, if it's to drink more pina coladas on the beach, if it's to basically retire your spouse, if it's to put your kids through school, if it's to basically retire your parents, travel, or upgrade your things, you're going to need some cash to do that. And I'm not talking you got to spend 30 years doing this. I'm saying that the next 6, 12, 24 months are going to be life-changing for a lot of people. And it could be good for you, or you can sit around here and be, man, I wish I'd have taken action. It's never been easier than it has been now to find deals out there, ladies and gentlemen, and the banks are sweating buckets. Time to start putting some money in those buckets in your own pocket for you. So guys and gals, get signed up right now, guys. Noteweekend.com. Take advantage of the offer. $49 for all those bonuses. And hopefully we'll see you at a class nearby. Any questions or comments before we let you go for the evening, everybody? All right. Well, thank you so much. Once again, please, would love to see you at Note Weekend in just a couple, actually in 2 Saturdays from now based on this, but we always have them, like I said, once a month. We update the noteweekend.com with the most recent, most upcoming schedule. And like I said, guys, take advantage of it. Basically a quick little business in the box for you to get rocking and rolling for you and make this next 6 to 12 months the most profitable in your real estate career. Have a great evening, and we'll see you all at the top, everybody. Bye.